My name is Derek Prusha, and I'm from Ferris State University. Most exciting part was working with the team and getting to see the inside operations of a company. We got to talk to the CFO, that was pretty exciting, but definitely working as a team and cooperating with all the individuals in our group was very exciting. I think it was just about the level that we expected it to be on because we knew that this would be a challenging task, so we knew that it would be tough going into it. I'm going to be sitting for the CFA Level 1 exam for this June 2nd, 2012, so this kind of shapes it into showing me what kind of stuff I can expect to do in my future career. So it's definitely a good experience in showing me what I can expect in the future. I think it did because we actually got to meet with people and then evaluate the company, and we had to present like we were presenting to a board of directors or to the managers of a firm, so I think it was very realistic. Good morning and thank you for being here. Before we begin, we'd like to introduce the Ferris State University research team.
Trevor Worrell,
Michael Carroll,
Derek Prusha,
and Marilyn Markle. Herman Miller is a leader in researching, designing, manufacturing, and distributing office furniture, furniture systems, and related products. As of the closing bell, Herman Miller's current stock price was $21.52. Through analysis, our team has derived a 12-month price target of $25.08. This represents a 16.5% upside potential from its current stock price. Herman Miller was founded in 1905 and is based in Zeeland, Michigan. In the 1990s, Herman Miller focused on manufacturing efficiency, sustainability, and expanding their product pipeline. Nowadays, Herman Miller is a leader in manufacturing office furniture and furniture systems. As you can see, a majority of their revenues comes from the North American segment. North American sales represented 74.3% of all revenues in 2011, and we expect this to decrease to 68% by 2015. Non-North American sales represent 17.6%, and we expect this to increase to 23.2% in 2015. Herman Miller's biggest growth opportunity will come from international markets, and the biggest opportunity there would be acquiring Posh Office Systems, which is located in Hong Kong. This will give Herman Miller direct access to the Chinese market, which has seen an increase in living standard and a thriving real estate market. Herman Miller's competitors are Knoll, Steelcase, H&I, and privately owned Hayward. Herman Miller's biggest competitor is Knoll, as they both operate in the high-end segments. Herman Miller must pay attention to Steelcase, as they operate 21%, or they control 21% of the overall market. Currently, Herman Miller controls 12.5% in 2010 and 14% of the market in 2011.
To evaluate Herman Miller, we used a discounted cash flow approach while integrating a three-case scenario analysis, consisting of base, worst, and best case scenarios for the firm looking forward. We also assumed a weighted average cost of capital of 7.08% and a 1.075% terminal growth rate. Herman Miller does not give out individual country information for its international business, so we valued their assets as a whole. For our base case, we see sales rising to over $2.1 billion with a 6.44% compound annual growth rate from now through 2015. For these sales levels to be realized, we expect the unemployment rate will continue to trickle down. As this happens, consumer confidence will increase, causing an increase in small business formation. This small business formation is a key in the rising sales of Herman Miller. As larger companies begin to hire again, they may have the option to use currently empty office space caused from the massive layoffs during the recent recession. As newly formed businesses that are smaller begin, they would have to buy new office furniture for the entire area. This is all assuming that nothing major happens to impact the company's growth, GDP, or other economic factors. In this scenario, we see Herman Miller at a $25.88 price target. For our worst case scenario, we see sales bottoming out at $1.15 billion with a negative 10% CAGR from now through 2015. Although this is a major retraction, this keeps Herman Miller sales levels above the 2009-2010 recession levels. We kept sales above these levels because this is arguably the most severe collapse since the Great Depression. Also, companies have learned from the past and are much leaner now. In this scenario, unemployment would remain extremely high and the small business creation would be minimal. Also, large companies would cut back on their spending for office furniture. This scenario also takes into effect the risk for a global recession, which we feel is very possible given the current economic environment, especially in Europe. This gives us a $15.76 value. For our best case, we see sales rising at a 14.8% CAGR from now through 2015, just as they did from 1977 all the way through 2000. This scenario captures the added sales Herman Miller would see given stronger than expected growth in the United States and in the rest of the world. As unemployment rates would drop at a rapid pace, the small business creation would boom. Also, with high CEO confidence, larger companies would even be spending more on office furniture. Our three scenarios give us three very different target prices. To capture each, we assign probabilities to each scenario to come up with a weighted average target price. For our base case, we have a 55% probability. For our best case, we have a 20% probability. And for our worst case, we have a 25% probability. These probabilities stem from current economic forecasts but have been adjusted to reflect what we feel is appropriate. After applying the appropriate weights, we derived a final target price of $25.08.
This past fiscal year, all sectors of Herman Miller saw significant growth. Their net sales had increased 25.1% to $1.65 billion. We expect this trend to continue through 2015, with sales reaching $1.75 billion in 2012 and $2.1 billion by 2015. Likewise, their EBIT will also rise. We expect their EBIT to reach $138.2 million by 2012, with more specific EBIT margins increasing to 8.8% by 2015. Herman Miller's margins are also said to increase. We believe this will be because sales will outpace their input costs, such as labor and direct materials. Our forecasts expect their direct material commodities to rise at about 5.19% through 2015, with their sales at 6.44 compounded annual sales growth. Herman Miller's margins will also see added benefits coming from continued operational efficiencies, as well as their overhead costs being combated by higher sales and their lean manufacturing activities. Herman Miller's operating cash flows over sales will hold steady at about 6.7% through 2015. Herman Miller's operating cash flows should amount to about $140.9 million by 2015, with the majority of these free cash flows then being restricted to fund Herman Miller's capital expenditures, which should amount to about $159 million between 2012 and 2015. Herman Miller has actively been deleveraging their balance sheet. In fiscal 2008, they had debts reaching $375 million. Currently, their balance sheet only holds about $250 million, with their next debt payment due in 2015. Herman Miller's diluted earnings per share were $1.06 in 2011. And we expect a 36% increase to $1.44 in 2012, and a 53 sum total increase to $2.13.
Next, we feel it is important to highlight Herman Miller's management team. Brian Walker is the CEO and has been at Herman Miller since 1996. Greg Bleisma is the CFO and has been at Herman Miller since 2000. Both of these individuals, along with several of the company's vice presidents, receive a large amount of their compensation through option and stock awards. This gives them an added incentive to keep the stock price up. We believe this also helps to mitigate the investment risk of the company, which we will now discuss. The investment risks for Herman Miller are located in the matrix, with impact on the x-axis and likelihood on the y-axis. The most relevant risks are closest to the top right portion of the matrix. Of these risks, we believe the 5 biggest risks to our price target are, first, macroeconomic conditions. Given the cyclical nature of Herman Miller's business, much of their sales are dependent on U.S. commercial activity. The most influential factors are CEO sentiment and the Architectural Billings Index. Second, failing to expand in international markets. Management sees their biggest growth opportunities in the next 5 years coming from Asia and Latin America. If they are unsuccessful in increasing their exposure in these markets, it would have an adverse effect on top-line growth. Third, losing sales from the U.S. government, as 14% of sales in fiscal year 2011 came from the U.S. government. If they lose sales from them in the future, this would also have an adverse effect on top-line growth. Fourth, increasing raw material costs. Herman Miller is exposed to 4 main commodity costs, which are all projected to increase in the next 1 to 2 years. If these costs were to increase at a faster rate than anticipated, margins could be impacted. And fifth is stronger competition. As Herman Miller competes in very competitive markets, if they face increased pricing pressures going forward, this could also have some impact on margins. Lastly, we'd like to summarize the main points of our analysis. Almost every economic factor important to office furniture sales is slowly improving. Combine this with international growth, and Herman Miller will continue to see an uptick in sales. Additionally, we see potential for an increase in U.S. market share, which would also benefit sales. In the end, sales, earnings, and margins are what drive the stock price, and we believe Herman Miller will be successful in increasing all three of these, complementing our price target of $25.08. That concludes our presentation. We'd be happy to take any questions you may have.
So we're coming out making this a buy.
Yes.
We're saying that Herman Miller is a buy, and that if I got back down to $15.76, it is a real big buy.
Yeah, that would be a strong buy.
Okay, strong buy. Good.
Especially in the $15 range, management has often in the past exercised their stocks at that price to buy. So it kind of created a floor for it in the past at the $15 range.
You mentioned that management, a lot of their incentive is stock options and stocks. What percent ownership is inside?
Insider, I want to say it's really low. I'm not sure the exact percentage, but I believe it's maybe less than 10%.
Can you address their international exposure, particularly their acquisition of Posh, in terms of what you expect that to be able to deliver in Asia? And then touch a little bit on how they're developing and expanding their business in Latin America, since that's a key part of their growth.
Well, what we would expect acquiring Posh is that they would be able to penetrate the market in China, and that they wouldn't deal with any type of taxations there, having to import from China and export and back and forth. And since they're technically acquiring Posh, they're acquiring all of the manufacturing, and so we're expecting them to have a lot of increased sales from there. They're increasing the infrastructure over in China a lot. I believe it's 1.2 billion square meters per year. So we're expecting them to increase their furniture sales as well over there. And then in Latin America, they're currently planning to, or they're in the talks of. Okay, go ahead.
In Latin America, they have one showroom and design center in the capital of Brazil. That's the only exposure they have to the continent. So to increase their exposure, we kind of factored in that they would acquire a company somewhere in Brazil to further increase sales going forward, but the management hasn't disclosed what they are going to do.
Has management disclosed that they want to expand in Latin America?
Yes, because they see the biggest growth opportunities coming from Asia and Latin America in the next 5 years. So.
And acquisitions, are they being funded through cash flow or is
Yes.
sufficient free cash flow?
Yeah. As far as Posh goes, they haven't disclosed how much it's going to cost, but we know there's going to be an upfront cash payment going forward. We don't know what the exact amount's going to be.
Their European exposure, obviously we get headline news every day about what's happening in Europe and the challenges of likely recession taking place right now in Europe. What about, how will that impact what they're doing in Europe and their existing business in Europe?
Well, if Europe goes into a major recession, that would obviously impact all the companies over there, so they would start purchasing less office furniture. They cut their office furniture budgets because this is one of the lower importances of running a business. The manufacturing comes first and the office furniture comes second. And also, other than just in Europe, it would affect the United States and the rest of the world because the United States companies that buy from Herman Miller would see lower sales growth in the European markets, so therefore they would not have as much cash flows coming through, so they would start to cut back also. So if the European economy goes into a huge recession, it could impact their sales globally as well as in Europe.
What kind of competition do they have in Asia?
Asia, from our analysis, as we made an analysis in China because that's where they're going to be with Posh and then expand from there. The market in China is pretty fragmented as far as competition goes. And a lot of Herman Miller's competitors in the U.S. have already established themselves in China, so there is a competition factor to look at. However, the growth is so high in China, we believe that they will be able to increase sales going forward, even if they don't as much as they would like to.
With sales from the government running about 14% of their revenues, and with all that we know is going on in Washington and also at the state level, do you have any kind of breakdown between what kind of penetration they've got in say, federal government versus state governments? Because, we're seeing rolling recessions continue to go through state governments and spending at the state government level. So,
we don't have it for the state and federal level. We just know that the They obtain government sales through two methods, competitive bids, and then they're on a contract schedule as well. Certainly going forward with the budget problems in Washington, they could see cutbacks. There will probably be an office range or two. And so we did factor that into our base case, or our worst case scenario.
This expansion into more international markets, Asia and Latin America, does it require increased R&D spending to come up with new innovative products, or existing products well enough to satisfy markets?
I think that the research and design is probably going to have to be increased by a significant amount, just because they operate in the high-end segments. They already have very innovative, very brand recognizable furniture, so they're not going to come up with something completely and totally different. So once they take it from North America and they take it over into their international markets, they'll probably stay along the same lines, as well as they're acquiring Posh, so they're not going. I don't believe that they will just wipe out all of their manufacturing.
I like your economic scenarios, worst case, base case. What do you use a consensus for those, and how did your evaluations, or
Well,
how do you come up with those? Or how you come up with what you use for data, consensus economic data, and then how you came up with the percentages where you thought the base case would be 55.
Okay, as far as the probabilities, there was a BlackRock economic analyst that we found online that had a 40% chance of recession and a 10% chance of best case. We felt that the 40% chance of recession was way too high, considering that we've been making significant progress. So even with the tough times in Europe, we see that the economy is progressively getting better, especially with the unemployment rates that just came out. That shows that the U.S. economy is getting stronger, which is still where most of Herman Miller sales go. So we kind of lowered that a little and raised the best case a little bit. And for our sales growth, we decided that it would be smart to see a 30% increase from our base case for our best case scenario. We use this because it would reach the same levels of growth as they saw in the past from 1977 all the way to 2000. So even though the market has matured and they're a maturing company, so they're not going to see huge growth, we see that if the economy does boom, there is potential for that. And for our worst case, we didn't want to bring their sales levels down all the way to the recent recession, because we feel that if there is a double-dip recession, it won't be nearly as significant as the first one. So that's why we chose those sales levels.
Did you want to know about the indicators as well, or?
Yeah, we use them selling using BlackRock. So.
Okay.
Yeah.
Thank you very much.
Thank you.